Good afternoon. Welcome, those of you that are online with us. Special Q&A and opportunity to hear about the government's latest changes in the rules relative to the coronavirus. We have a couple of expert helpers with us here that are going to be talking with us this afternoon. First, I'd like to introduce Brandon Hall. Brandon's online with us. Brandon is a CPA, specializes in real estate tax, but is knowledgeable in all areas tax, and is going to be our guide through some of the new regulations in this act, and there are many. So he'll be commenting about those and answering questions regarding those. We also have on the line Chris Marasco. Chris, are you out there? Let's see if we can find Chris. I hope he's out here.
I'm here, Leonard.
Oh, there he is. All right.
I am
Chris
here.
is our banker on the line. Chris is with Revere Bank and is on to help us answer questions and understand the items going on in our circumstance with the SBA and loan forgiveness and loan applications and all of the newest, latest that the SBA is throwing our way. So, simple start of the program. We all know that we're locked in houses all over the country. Thank you for joining us. And there have been federal government changes in tax law, in SBA rules, in retirement plan rules, a whole host of new and exciting items that are going on as a result of, unfortunately, the coronavirus. So we're going to look at three different elements of this, as I said, and I'm going to put them out kind of in this order. The first thing I'm going to do is talk about a couple basic tax law changes relative to retirement plans and relative to filing dates. Then I'm going to have Brandon jump in, and Brandon, you can jump in anytime if you feel that there's something that you want to share about anything I'm talking about relative to the tax law changes, and talk about the more significant changes other than just filing dates and what they could mean to you. And then we're going to have Chris jump in. He and I are going to have a conversation about the SBA and the loan programs and loan forgiveness programs and the various things that are coming up. Suffice it to say, these have been fast and furious. The government's changed a lot of rules very quickly, and not all of the ink is dry, and not all the rules are out. So we're still waiting to find out some things about what's going on in these rules. I'll chime in with just the first one is a real easy one, and that is for those of you that are preparing your taxes and getting ready to file them, you don't have to race off to your accountant. If you haven't already done that, you haven't been to Brandon's office yet, or to your CPA's office, you don't have to rush in and get those done because the IRS has said that tax returns are not going to be due on April the 15th. They've extended that deadline for filing out to July 15th, 2020. So in the beginning, what was proposed was taxes wouldn't have to be paid until then, but you'd have to file an extension. Then they came along and said, no, you don't have to file, and you don't have to file an extension, and you don't have to pay your taxes until April the 15th. So as a business owner, if you're in need of that cash flow and you want to hold on to that cash, certainly you're in an opportunity position to not make payments to the IRS until July 15th. Now, the second, and what came right along with that, was the quarterly estimated payments of taxes for all taxpayers that are due on April the 15th with your filing of your 2019 taxes. Those estimated payments have also been deferred now to July 15th. So your first quarterly 2020 estimated payment due April is now due in July on the 15th. A strange thing happened on the way to the bank. Don't know if they're going to change this. They're talking about a fourth wave of stimulus. There have been three. They're talking now about a fourth, and they'll probably make some technical corrections to the three. But in the act here, although you don't have to make your first quarterly payment until July the 15th, you still have to make your second quarterly payment on June 15th. So you will be making your second quarterly estimated payment before you've made your first quarterly estimated payment. Don't know if they're going to change that, but right now that's the way it is. So you'll have to make one in June, one in July. So that's the first and foremost. Now, what comes right along with that, and reason I want to touch on these, is some significant rules relative to IRAs. And that is contributions to an IRA or Roth IRA for 2019 contributions are allowable up and through the date of the filing of the tax return, or in the past, April 15th, whichever was earlier. And now, because they've pushed the date of filing back to July 15th, you can fund your 2019 IRA or Roth IRA contributions up and through July 15th. So it gives you, again, as a business owner, an individual, a little more time to hold on to your capital, put it into the IRA or the Roth IRA later in the year. Don't have to fund those till July the 15th. So you get a little break there on the funding relative to IRAs and Roth IRAs. I'm going to touch on a couple other retirement plan rules, and I'm going to turn it over to Brandon to talk about some other tax items that are going on, and then I'll interject along the way. Other couple things that are involved with retirement plans. First, if you are over 70 and a half in 2019, or if you turn 72 this year in 2020, you in the past obviously have been required to take a minimum distribution from your IRA, not Roth IRA, but from your IRA. Those 2020 IRA required minimum distributions have been waived. So if you don't want to take a required minimum distribution in 2020, you don't have to. Now, I want you to meet with us or your advisor, your accountant. You want to make sure that you understand the ramifications of not taking it. I will say that because given what the market has done, the stock market, if your IRA is in stocks and it's gone down in value because the equity markets obviously have gone down in value, it may make sense still to take your required minimum distribution and move that money to your personal investment account, allowing the recovery in the market to occur in a better taxed environment of a capital gains treatment rather than an ordinary income waiting to be taxed IRA marketplace. The other thing that you could do is you could do a Roth IRA transfer and move monies from your IRA to a Roth IRA. One thing I haven't seen, and Brandon, I'll ask you if you've seen anything on this, I haven't read it yet. In the past, you had to take a required minimum distribution in order to then, over 70 and a half or now 72, fund to a Roth IRA with excess withdrawals. Since the required minimum has been abandoned and you don't need to take it this year, I don't know if you can take a distribution, move it directly to a Roth without taking the required. Have you seen anything on that?
No, I haven't seen anything on that specifically. The only thing that I have seen is that you can take a withdrawal from a qualified plan up to 100K and spread the income tax payments out over 3 years. Right. Or if you repay it within 3 years, then you don't have to pay the income tax on it. So.
Right. So they've expanded, what he's talking about there is they've expanded the rollover, the distribution rules from IRAs, qualified plans. So the deal here is if you are COVID virus impacted, and there's a whole host of things that means. We're not going to get into all of that, but if you're out of work because of the virus, if you're impacted income because of a shutdown, things like that, a family member is diagnosed, those things allow you to take money out of an IRA up to $100,000 under 59 and a half and not pay any penalty for it. So again, an opportunity to potentially take money out of an IRA early if you so choose, pay the taxes, but not have to pay the penalty. And as Brandon said, the other part of that is that when you take the money out of the IRA, the taxes are spread over 3 years. So you'll pay those taxes in the future, depending upon your tax rate. Then you don't have to pay the tax rates this year on the whole lump sum that you withdraw. So that's another change. Another piece, just to wrap up the RMD piece, if you've already taken your required minimum distribution and it qualifies for rollover treatment, That is, it's one per year. It's been within 60 days. You can choose to put it back and not be taxed on it because this rule just came. So if you took your RMD in February or March and now you want to put it back in and you qualify for that, you have the opportunity to put the account back in as a rollover into your IRA. So that's available for you as well as a change in the rules. Other quick things on retirement plans, IRA beneficiaries that may be subject to the 5-year rule don't have to take their distribution this year from a required distribution standpoint. They too can roll that, let it happen in 2021. So in effect, you're getting a little bit less money taxable this year, a little more money taxable in 2021. And in either case, one thing I don't think I mentioned, in either case, you do not have to take double the distribution in 2021. The amount you don't take in 20 is completely off, gone, done, forgotten. And in 2021, you'll calculate your distribution and take out in 2021 what you have to take with no makeup for the 2020 that you did not take. So they're not making you tax twice. In the future, they're only giving you a tax break. The whole idea is to keep people from having to pay tax today, letting them keep money in their pocket so that when the economy turns, people can spend that money. This is pretty much a business owner provision that they put in also. It allows business owners that may be at that point to not have to take that money out, or if they did take it out, use it for working capital. And these tax benefits then inure to the business owner. So that 10% early withdrawal penalty is there. The other thing, last thing, is loan relief. And that is, until now, 401ks, borrowing from 401ks and retirement plans, not IRAs. You can't borrow from an IRA, but from a 401k or other retirement plan with loan provisions. Your employer does not have to have loan provisions. You as an employer do not have to have loan provisions in the 401k. But if you do, or if your employer does, the loan amount used to be, or is normally, the lesser of $50,000 or 50% of your account value. Then once you borrow, the loan gets paid back over a period not to exceed 5 years. Now what's happening is you can borrow up to the lesser of 100% of the value of your 401k or $100,000. So you can take twice the amount you could take before to borrow for opportunity to keep your business going or whatever it is you may need that capital for. And payments are deferred for 1 year. So you don't have to make payments on that loan in 2020. Lastly, anyone with an outstanding loan right now on their 401k, the administrator of the plan can allow deferral of payments, and you don't have to make payments the rest of the 2020 year. So you're going to have an opportunity to potentially hold on to more cash, let the account be, pay it back in the future. If you have that loan outstanding right now and you don't want to pay it back right now, it gives you another year to make that payment. So those are the big retirement plan changes. They're significant. If you need more information specific to you, reach out, send us an email. We'll make sure to get you on the calendar, give you a call, see if any of these things apply to you specifically. Very important. I think the most important there is the tax filing dates and the contribution dates and the ability potentially to take money out of the plan without the 10% penalty. So those are the things, highlights from that standpoint. I'm going to pass it over to Brandon. Brandon, I'd like you to chat about the various tax programs that are here and the employee retention credits, the 139s, the 7As, whatever that stuff you want to get into, and then we'll pass it to Chris to talk about the SBA.
Yeah, what's going to be relevant to everybody here? If you are a business owner and you have employees, could you just throw like a 1 in the chat real quick? That'll help me kind of just tailor this a little bit. And while we're doing that, just one quick change on the charitable contributions. There's now a $300 above the line contribution. And what that means is that you don't have to itemize your tax return in order to take that above the line contribution. So everybody can take a small charitable contribution this year in 2020. In terms of the big tax changes, so there's a lot of there's a lot of employer tax credits that have been rolled out over the past 3 weeks. And a couple of those First, we have the sick pay, the medical leave. So your employees, if you are an employer with less than 500 employees, your employees can take 2 weeks of sick pay, and they can take an additional 10 weeks of family medical leave. Excuse me. And you still have to pay them during that entire time period, and as long as they are on your payroll and you're not furloughing workers. So while you pay them during that time period, you will get a tax credit on your payroll costs to be recovered throughout the rest of the year. There's the DOL is supposed to be releasing guidance on employers with less than 50 on how they can opt out of that, how they can claim an exemption, but that has not yet been released, at least to my knowledge, unless it was released today. And you will have to be able to demonstrate how your employees going out for an extended period of time is going to create a going concern for your business, meaning it's going to potentially shut you down if your employees leave for an extended period of time. So that should be coming out relatively soon. And if you do have less than 50 employees, my advice to my clients is go ahead and apply for that so that you can get that exemption. But if you can't get the exemption and your employees do go out, you do get a payroll tax credit there. There's also the employee retention credit. So if you are retaining employees during this time period, you will get a payroll tax credit there. But most of our clients are looking at the Paycheck Protection Program, which is a brand new, I guess, maybe rescue. We've been arguing whether or not to call it a stimulus or a rescue, but a rescue package loan that's come out as a result of the CARES Act. And if you obtain that Paycheck Protection Program, if you obtain that loan, then you cannot qualify for that employee retention credit. But that Paycheck Protection Program is going to be huge. And I believe you said that we had a banker on the line, so maybe I'll let him talk about that specifically.
Yeah, we'll let Chris go into that, and I'll supplement with him when we get to there. So
yeah, cool. So in terms of the actual tax stuff, the biggest two things. First, qualified improvement property. So if anybody owns commercial real estate, or if you invest in commercial real estate, or if your business owns commercial real estate, qualified improvement property is improvements that you make to the interior of non-residential property. So not like a single family home that I own, it has to be commercial real estate, non-residential. If I make improvements to that interior, then it's called qualified improvement property. When the 2017 Tax Cuts and Jobs Act came out, they meant to give qualified improvement property a 15-year life, and that would have qualified it, not to be confused with qualified improvement property, that would have qualified it for 100% bonus depreciation, but they left it out of the final bill that passed with the 2017 Tax Cuts and Jobs Act. So qualified improvement property had a 39-year life and did not qualify for 100% bonus depreciation. So what they did in the CARES Act is they made a technical correction, and they retroactively allow qualified improvement property to be depreciated over a 15-year life, which now means that if you had any qualified improvement property in 2018 or in 2019, you can go back and retroactively deduct that via 100% bonus depreciation, which then leads to the next thing. So now we have net operating losses that we can carry back 5 years. So net operating losses were pretty much eliminated with the 2017 Tax Cuts and Jobs Act. Any net operating loss that you incurred would be carried forward, and it was limited to 80% of your income on a roll forward basis. So a net operating loss is when I have one business that, or say I have like 100K of total income, and then I have a business that produces a 200K loss. That spread of 100K, that's a net operating loss. So the 2017 Tax Cuts and Jobs Act said we're no longer able to carry those back. We can only carry them forward, and you can only take 80% of your future income. Well, if you're running a business that always produces losses like a lot of real estate investors do, that's a problem because you never have positive income. So you just have this big loss that stacks up. What they did here is they pushed out the excess business loss limitations, which I don't know that we necessarily need to dive deep into that. Very important though, so if anybody wants to know about it, we certainly can. But they pushed that out to start 2021, and so now 2020, 2019, and 2018, if you generate a net operating loss, you can carry it back 5 years. So we work with a lot of real estate clients. So what we are doing right now is we're doing a lot of cost segregation studies. We're getting bonus depreciation, and we are basically front loading all of the losses as much as we possibly can in 2018, 2019, and 2020. And then we're going to be carrying those losses back for 5 years back into the past and claiming a refund. And that's important for anybody that can create net operating losses. You should take advantage of it. And anything in this stimulus package that you can take advantage of, you should take advantage of it, simply because we don't know how long this thing is actually going to last from an economic perspective. And so if you could pad your pockets in any way, we 100% recommend jumping on that.
Brandon, how about the deferral of employment taxes? Have you seen that?
Well, yeah. So we haven't done like a lot of technical research there.
Okay.
A lot of our clients are on the real estate side. They have
Gotcha.
employees, and we're kind of working through it with them. But
Okay.
do you have a
So-
specific question about it?
No. So what's come down in the act also for business owners is that you have the opportunity from yesterday, from the Friday, the date of the act, through the end of this year to you have to withhold, but you do not have to send in the 6.2% of the employer's share of the FICA tax on employees' income. So to the degree that you have employees and you normally make a payment through your payroll company for the FICA tax for those employees, you do not have to pay that FICA tax to the government in 2020. Now there's a couple stipulations to that. One of them, well, what happens is it's not forgiven, it's just deferred. And if you choose not to pay it, you'll escrow it. You have the right to defer it. And then you have the opportunity to pay half of the tax you should have withheld in December of 2021 and half in December of 2022. I can't imagine a finer opportunity than the government giving a zero interest free loan for basically 2 years, 9 months. So any FICA tax that would have been withheld, you don't have to withhold. For the employer side, this is not the employee's money, this is the employer side. Use that money to keep your business running, pay your employees, do what you want to do, pay back half at the end of 2021, half at the end of 2022. Now, there is one stipulation for not doing that. And what the government has done is they've not allowed us to double and triple and quadruple dip here. So as we'll hear in a few minutes, there is this thing called the Payroll Protection Plan money. And if you choose the PPP money, as it's called, then you cannot defer the FICA withholding. So you can't take advantage of the FICA withholding and the Payroll Protection Plan money at the same time. So you'll have to measure, we can work on this together, which is a better deal for you depending upon the PPP or the FICA tax. I'm guessing for most everybody, the PPP will be better, but we need to look at those numbers to be 100% sure. So that's what's going on there. Brandon, are you familiar with the Section 139 money?
Oh, yes. Yep,
So
absolutely.
can you chat about that a bit?
Yeah, so Section 139 is, I believe that it was written after the September 11th attacks, but basically what it allows you to do is during a federally declared disaster, and IRS Notice 2020-18 officially declared this as a federal disaster per the president's words. What you can do with Section 139 is you can pay employees for certain expenses that you otherwise could not get a deduction for, or that they would otherwise have to pay income taxes on. So medical costs that are not covered by insurance, any costs that are related from working from home, like the cost of equipment, utility increases, any funeral costs, you can pay your employees. Tom, actually, do you have that report that we put together? Could you pull it up real quick and maybe just throw in the chat all those costs? We have a whole list of the things that you can pay employees, but you can pay employees a whole bunch of different costs. They get the income and it's tax-free to them, but you still get a tax deduction. And that's why it's powerful. It's only enacted in times of federally declared disasters. So sometimes hurricanes and things like that, but definitely something to look into. And if you keep an eye on the chat, actually Tom sorry, is that okay if we just paste it? Okay. So Tom in the chat there just pasted a report that we put together summarizing all of this. I think the very second section is Section 139, and you can read all about the different costs that you can pay your employees for that, again, they don't pay income tax on, but you still get a tax deduction for.
Excellent. One other thing I'll mention, we talked about this a little bit in our last chat, and at that time what we said was relative, this is to student loans, that if you had a student loan, you should call your borrower and discuss not making payments, deferring payments perhaps. We also noted that if it's a federal loan, that the government was deferring potentially payments for 90 days. Well, now that this is all done, lo and behold, they didn't. They deferred through September 30th. So we've got 6 months of not having to pay government student loans. Let's be clear, these are not private student loans. There you'd have to still talk to your banker. But with government student loans, Sallie Mae, the interest is deferred for a 6-month period and no payments are necessary for the 6 months. And they pick back up under the current rules, October. Again, not knowing how long any of this is going to last. Could they come back and defer longer? Sure, they could. But the good news is for right now, no interest accrued on the loan and no continuing payments on the loan for the next 6 months. Gives you a chance, again, to keep that money in your pocket, keep your powder dry, use it for opportunity or to run your business or to pay your bills so that you don't have to worry about coming out of pocket for those dollars. And when they're not charging you interest and not causing you to pay, then that's a tax-free, interest-free loan from the government for a 6-month period for everybody with a government student loan. So we want to make sure you take advantage of that. Next on our list, and this gets into all the big stuff, is money from the government directly and indirectly. So directly, you've probably heard about the phase 1 numbers, and that is everybody that has income that filed a tax return 2018 or 19 is going to get it. Not everybody, but almost everybody is going to get a check. How that's going to work is if you make under $75,000 as an individual, under $150,000 as a married couple, you will get $1,200 per person in a tax check, just basically put in your checking account to keep you in food and shelter and dollars in your pocket while this is all going on and everybody is sitting at home. There will also be a $500 per child credit, and that is for children under the age of 17, claimed as dependents on your tax return. Now, if you're over the 75 or 150 as a married couple, it phases out. And then ultimately, when you make too much and you're too rich, as with everything else, the government doesn't give you any benefit. So just know that if you make too much, you're not getting it. But certainly look in your bank accounts or in your mailbox, depending upon how you filed your taxes in the past, whether you've direct paid or gotten a check or paid by check. $1,200 per person, $500 per young dependent. If your children happen to be like my son, 17 years old, well, it's just too darn bad. You're not getting any money for him. So no kids 17 and up are getting checks back to the parents. If they are independent, working outside the home, perhaps they'll get a check. I haven't been able to clearly verify whether they will or won't based on their own taxable income. It's kind of squirmy in the law there. Brandon, have you seen anything that explains whether or not a independent 18-year-old will get a check?
Yeah, I believe that they will.
Yeah, here's hoping.
Yeah. If they're not being claimed as a dependent, and they should be able to.
Yeah. So they'll be filing, they'll get their own, and as long as they filed an 18 or 19 tax return, they will get a check. If you're a retiree on Social Security, you get a check. So the government is basically sending lots of checks out, and that'll either be direct deposited into your checking account or sent to you as long as you filed an 18 or 19 taxes. There is one and only one reason that you would not get this check that I've been able to decipher from my reading of everything, and that is if you are in arrears of your child support and the government knows about it, then they will withhold your check to pay your child support. Other than that, if you owe the government money, the federal government, the state government, you have an overdue library book, it doesn't matter, you're getting your check. So the only stipulation against is unpaid child support.
And just one real quick thing on that. If you have not yet filed your 2019 returns, you want to look at your 2018 returns and your 2019 returns and figure out if you file your 2019 returns, will that actually cease your ability to get the check? Because there are phase outs. If you're single, start being phased out of this check when you hit 75K in income. If you're married, I believe it's 150. So look at the 2019 returns. If your 2018 has lower income, hold off on filing the 2019 returns. If your 2019 returns has lower income, speed roll that, get it done.
There you go. All right. Chris, you out here for me?
I am out here.
All right. Let's talk about some SBA and bank opportunities for our clients here and for people on the call. So let's start with I guess we've talked about it a little bit. Let's talk about the PPP and what you can tell us about the PPP.
Well, as you mentioned earlier, things are fluid and information is changing rapidly. In the time since this call has started, the SBA has been able to release the application for the PPP program. And we being banks can begin submitting on Friday. So that's good news for anybody that wants to take advantage of that program. So that program is part of the much bigger act, and it is designed for payroll protection, PPP, the payroll protection program, and it is to reimburse, if you will, probably the truest thing you'll get to free money from the government, expenses related to payroll and payroll taxes and benefits. So, for example, if you as a business needed a loan from the SBA through the 7A program, and you wanted to borrow $300,000, and $100,000 of that was related to payroll incurred expenses, based on their calculations, you would be eligible to not have to pay back that $100,000. So they have a calculation where they will take the trailing 12 months, your average payroll expenses, you multiply that by 2.5, and that's the maximum amount that you can get under the payroll protection program. If you follow all those guidelines, you will be eligible, follow all the guidelines they have put out, you will be eligible to have that loan forgiven. Does not have to be part of a larger SBA 7A loan. You can take advantage of the PPP just for the 2.5 times you need.
What if you choose?
All right.
What if you choose to take a loan for more than that?
If you choose, as I tried to illustrate earlier, if you take a loan for more than that, the portion that will be forgiven is the portion that is 2.5 times the trailing 12 months of your expenses related to payroll. Average trailing 12 months.
And again, health insurance costs, payroll processing costs, anything that's related to payroll.
Anything related to payroll. I don't believe that 401k matches are part of the program.
Correct. I did not see that in the listing.
Right. But payroll taxes, retirement plan benefits, insurance benefits, so all those seem to be part of the program.
Now,
While those are the numbers used to determine the maximum amount that you can qualify for in the forgiveness part of it, they are not limited to be used just for payroll. They can be used for operating expenses such as rent or utilities or mortgage interest. And for some, this was a good thing, they have broadened the definition of utilities to now include internet service.
So if I wanted to borrow, I would calculate my payroll, all the ancillary costs associated with it. I would take that 2.5 times a monthly average, and that's how much. Basically, what I'm hearing is the federal government is willing to give me that money as a grant. Free money. Does not have to be paid back any way, shape, or form.
Well, there are stipulations to that. You can't just take the money and run, if you will.
Right.
You're going to have to provide copies of checks. You'll have to provide invoices. You'll have to provide employees' names and other forms to qualify for that forgiveness. So if somebody does take advantage of it, they would be well advised to track every penny.
Yeah, and so I have to keep my employees, I have to keep paying my employees, but as long as my business is up and running and I'm paying my employees, I can get this money.
Provided you meet the qualifications.
And is there a maximum?
It's the government. You have to meet the, I'm sorry, say that?
Is there a maximum amount I can do this with?
I think 10 million is the top number.
So if I have employees and my payroll for a month is $250,000, I can get $500,000 basically from the government, interest-free grant money, tax-free, to have covered my next 2 months' costs. I keep running my business, I keep paying salaries, and they're gonna say I took out a loan for $500,000 and now I don't have to pay it back.
Simplistically, yes.
Okay. Yeah, obviously there's some hoops we got to jump through.
Yes, we're dealing with the government. There will be hoops.
Right. Brandon, you had a statement there?
Yeah, I've got a couple things. The payroll cost definition does include payment of any retirement benefits.
Okay.
But I guess, Chris, did you see something different, or did your team see something different?
What do you mean by that?
Well,
retirement benefits
we don't know.
probably needs to be defined a little further, because as I understood it, the 401k max was a gray area under retirement benefits.
Yeah. That's like the discussion right now in the CPA community is, what does payment of retirement benefit mean? And I guess that you could kind of go either way.
Yeah. So we'll have to find out and clarify there. But bottom line here is, and the maximum, sorry, Brandon, I saw you put in the maximum I can calculate for this is income up to $100,000 per employee. So earlier when I said my payroll was $250,000 a month, if that's 20 employees or 10 employees and the average payroll is 25,000, I'm fine. For the year, I mean, we're talking about $100,000 annual compensation divided by 12. So if somebody makes $150,000 a year, we can only count the first $100,000 of their compensation.
That's correct.
Okay.
And that's just for the calculation piece.
Right, for the calculation and for how much the government will give me in quote unquote grant money.
Right.
Now, Chris,
reimbursement.
Just real quick, Chris made a really good point about, just real quick, because Chris made a really good point about documentation. What we've been advising our clients to do, and actually, Chris, I'd be curious to hear your opinion on this. We've been like thinking about getting everybody to open up separate checking accounts for this money specifically, just for an additional audit trail. So I don't know if that's too intensive for people. It probably is, but it can help with some documentation.
I'm sure the bank wouldn't mind. So let me ask the next follow-up, just so we're clear. Let's say that this is the amount that I choose to borrow and I get that amount reimbursed, forgiven, but I want to borrow more than that from this program. Do I have the ability to borrow more? And if so, what are the terms of excess borrowing? Because I know the SBA.
Yes, you do have the ability to borrow more. I don't know what that does to processing time, because everybody has been so focused on the 2.5 times.
Got it.
So if you were to borrow more than 2.5 times, when the forgiveness piece starts, and mind you, so think of this as 2 separate programs, if you will. You have the program that gets you the money, and then the program that helps you get it forgiven.
Mm-hmm.
You got to follow the specific guidelines for both. So when you get to that forgiven piece, let's say that, I'll use my example again. You borrowed $300,000. $100,000 of that was your 2.5 times calculation. So you would be left with a loan of $200,000. That loan could then be termed out with the SBA and the bank on a 10-year, maybe up to 30. I'm not sure. I heard that
I
number
saw
kicked
10
around.
years.
Yeah, okay, so it is 10 years.
Yep.
At somewhere 3 to 4% interest based on other variables at that time.
So it would be a fixed loan for 10 years at 4% or below
That's what they're saying now, yes.
for the non-forgiven remainder.
For the non-forgiven remainder.
Got it. Got it. And is there any cost to apply for the loan?
There's no cost to apply. The SBA is absorbing the typical fee associated with an SBA program.
How about collateral?
If there is, no, this particular program, there's no collateral required.
So no application fee, no collateral, and a 10-year 4% or better with some forgiven.
That's accurate.
So as a business owner, this is a almost must do. Now, I know there are some people out there in the world who have this view that says, I'm not going to take any money from the government for anything. If they're going to offer, subsidies or grants or things like that, I'm not the guy or the gal that takes those. Other people can take that, but I made this business on my own. I run this on my own, and I don't want government money. You can certainly be that guy or gal if you want to. What I would say is for the portion of the free money under these circumstances, it might make sense to consider that significantly and recognize you are running a company. As such, you have bills to pay. Who knows how long this is going to go on, and if at least for the next 8 weeks while we're trying to get back on our feet, the government's willing to help pay those bills. What I can tell you is Boeing's going to take the money. Disney's going to take the money. Amazon's going to take the money. And if you choose not to, then you can just keep paying more taxes than you need to choose not to take the money. That's my personal opinion. You can certainly have yours. And if you choose not to take it, God bless. Chris, how about
Leonard, I'd like to point out that even just because you apply for it and assuming you qualify for it doesn't mean you have to take it. It also means if you take it, you don't have to use it, but it could be a backstop and a cushion.
Great.
Now,
great.
for some perspective, what I'd like to offer is that this is we'll call it $349 billion package.
Yeah.
For the PPP, that's 349. No, that's not right. Never mind. Calculation's not working.
It's a significant
So
block.
It sounds like a significant chunk of money, but, and excuse the office mates, they don't understand. No barking during meetings.
Okay.
This money is going to run out fast.
Yep.
There are hundreds of thousands of small businesses out there that will qualify under this program, and it will be a race to get in applications nationwide. It's a nationwide program. So Maryland had its own programs, but this one is across the U.S., and I see it running out quickly.
Yeah. So
Chris, how are you processing applications? Like
Interesting you say that. At 3:58, so just 2 minutes before we got on the phone, I got our email from our internal team that is focused on this, a copy of the loan application guidelines, and we're actually providing our clients with a maximum loan amount calculation Excel spreadsheet. So really all they have to do is look at the columns, fill in the blanks, and it'll calculate for them.
So a couple questions that I saw in the chat. Let me answer those or get answers to those.
Sure.
Doug
Sure.
asked a question: is there a maximum W-2 over 100,000? Employee A 60, employee B 120. The answer is 100 on the 120, 60 on the other. It's per person 100.
Correct.
Payroll. Dora asked.
Right. It's not an average number. It is
Right.
an absolute number. So
Right.
100,000.
Dora asked, is this for let me see, where was it? W-2 or 1099. This does not include 1099 workers. I've talked to people, SBA. 1099 means that they're a contractor, and contractors are being asked to apply for their own PPP money. So it's W-2 employees are the ones that are eligible as payroll, not 1099. The other question was, do owners' compensation count? The answer there is, if it is a corporation and you are the owner and you take a salary, your salary counts. If you're self-employed,
And it's capped at $100,000.
capped at 100,000. That's exactly right. An S corp, you would do your W-2. A C corp, your W-2. If you're self-employed with employees, you're in the situation where that 100,000 is the limit, and you have to again prove in the past if they audit what your income was and what it is. So W-2 employees are where the count is, and owners are considered employees of corporations.
Just a real quick note on the contractor piece. Our position is actually that you can count contractors as long as they are self-employed. So there's a provision that says the sum of the payments of any compensation to or income of a sole proprietor, independent contractor, that is wage, commission, income, net earnings, self-employment. And so that phrase has been like confusing a lot of people, and the general consensus, and Chris, I'd be curious to hear your take on it too, but the general consensus, at least in the CPA community, is that it's confusing, but anybody that you pay as an independent contractor could also count towards your payroll costs. And then if you are an independent contractor, your net earnings, even if you're not on your own payroll, could also be applied here. You can apply for the loan.
That sounds accurate. The company for which you are being a contractor could not claim you as an employee, and I'm actually not sure if it qualifies as part of the payroll expenses either.
Yeah, my understanding, my understanding from what I've heard, not 100% sure, but is that the W-2 employees count, that if you're a 1099 employee, as you just read there, Brandon, that's right, self-employed counts and contractors count, but they have to apply for their own funds as a contractor under the PPP, not as your employee. But again,
that's accurate. You're
the accountant, you're the banker. I'm telling you what I've heard. I've heard a couple readings. I don't think they count as payroll for the employer if they're a 1099. It's W-2, but they do get to use their own compensation for their own PPP. Okay.
Was that a question, Leonard?
What's that?
Was that a question, or were you done with your statement?
I think we're good. Are there any other programs that we should be telling? What about 7A debt relief? How about that? I read something about that. Are you familiar with that?
7A debt relief. Are you talking about the
if you have an existing
disaster relief?
If you have an existing small business loan.
I'm not as familiar with that, but I do know that they're suspending some interest payments. You could roll that into the PPP program if it qualifies, I think.
Okay. I thought I read, and again, I'll put it out there to the two of you. I thought I read that if you currently have an SBA loan, that interest and payments are suspended for 6 months. I saw that somewhere
that sounds
around the
that sounds right
stuff. There are so many moving pieces in all of this. Again, that it's fast and furious, and to be sure, if this applies to you and you have the loan or have an existing loan, then you want to talk to your banker about whether or not you have to keep making payments on it. Another question was, can you take the tax credits for sick pay and leave and also do the PPP?
That's beyond me.
Okay, so that's one we'll have to hunt the answer for.
Yeah, we'll have to.
I think that is separate. I think it's the employee retention and then also the deferment that you cannot do.
You can't do the deferment of the employment tax.
Right.
And the retention credit.
I think if you do the PPP, you cannot go for the retention credit, but you can still, I'm pretty sure that you can still use the 10 weeks paid and then the 2 weeks paid.
Got it. So you can't double, triple dip, but you can get some benefit.
Yeah, pretty sure though. You know, like this is
Yeah.
a $2 trillion package that we've all been looking at for 4 days. So.
Right, right. And as Chris said, 2 minutes before we came on, they came out with a
Right.
loan.
I'm really impressed by Chris, honestly.
So the other thing I would say to do, and in Maryland, we can talk about Maryland for just a minute. Chris, can you chat for a minute about what Maryland has offered from a loan standpoint? And that way the folks that are on from other states can check their own states to figure out if there's anything close. But can you give us a quick, what did Maryland come up with as well?
So Maryland, the first one is the Maryland Small Business Emergency Relief Grant Fund. That one you apply for directly with the state of Maryland. It's general terms, grants up to $10,000, not to exceed 3 months of cash operating expenses for Maryland businesses with 50 or fewer employees. Business must be established prior to March 9th, 2020, business good standing, and the annual revenues of the business or nonprofit cannot exceed $5 million, and they'll have to provide evidence of that.
And then there's a
The
second.
business is also, one more nuance of this program, the business is expected to seek longer term financing through its bank, SBA, or other source. So that was the Maryland Emergency Relief Grant Fund. Sorry, I've got a lot of screens open here trying to keep info fresh.
Got
The
it.
second one is the layoff aversion fund, workforce development and adult learning. That one is, again, directly through the state, and it's going to be used to provide funds to cover the cost of purchasing remote access for your employees, funds to cover purchasing of software, work sharing, and let's see, the qualifications there are, I think that's a maximum of $50,000. Yes, they may apply funding for up to $50,000. They have to have 500 or fewer employees within the state. They're up to date on their unemployment insurance, taxes, and in good standing with the Comptroller of Maryland and Maryland Labor.
Now that
And
one's
you'll have to be able to
loan, right?
demonstrate. That one is a loan. Yes, that one, you do have to demonstrate a need for layoff aversion support due to the impacts directly related to COVID-19, meaning that if your business has not been doing well in 2017 and 2018, you may have trouble getting this because they're going to say that your business was already in trouble, and this loan is essentially throwing good money after bad, if you will.
But
The
if you do a
third
legitimate business reversal,
Yes.
and you can get
The last
this
one is
money and the others, the federal money as well.
yes.
So I would say if you're,
So the last one,
yeah, go ahead.
Leonard, the last one is called the Maryland Small Business Relief Fund. That one's a little different than the other one. One's a grant and one's the relief fund. The relief fund has had a cap of $75 million available to Maryland businesses. Those are loans up to $50,000, 0% for the first 12 months, 2% for the remaining 36 months. Maryland businesses with fewer than 50 employees, deferral of any payments for the first 12 months, and then straight line amortization beginning the 13th month.
And that's
Again, all
that's
these
3
programs,
3 years at
that's
2%.
a total of 3 years. Yes,
1 year no interest, 2
all
years
these-
at 2%.
correct. So all these programs can be found on the Maryland Department, the State Department Economic Development website. I could send that link to you, Leonard, and you can forward it to the people that are on this call.
Excellent.
I will say that those have been out for a week and a half now. It'll head towards 2 weeks, I think, this middle of this week, end of this week. And they were receiving thousands of applications in the first few hours this was announced.
Yeah, and this is a first come, first served kind of deal. So
Yes.
I would encourage
Well, as
those
is the
in other states.
as is the SBA.
Yeah. I would encourage those of you that are in other states to look at your state's websites, state economic development, state small business, see if they have similar programs and get on this, because these funds are not enormous and everybody's trying to get them. and they're going to approve the applications probably in the order they get them. And when the money's gone, the money's gone. So same with the SBA. If you want to wait and make decisions, money might be gone by the time you do the application. So the application just came out this afternoon. I would say if it's something you want to take a look at, tomorrow's your day. Get in touch with your banker as soon as possible to get in line for these dollars. Doug has a question. Going back to the 12-month payroll averaging, should this data be run through the most recent payroll, if that's today? Where do we get the average number?
Since they said trailing 12 months, I would start with today and work backwards 12 months.
Okay, so something I would say to talk to your banker about relative to the application. It may be on the application. I've seen things that were February 15th. I've seen things that were the date of the act. I've seen things that say the date of the application for the loan. So I think you need to talk to the bank. And again, as of this afternoon, there had been applications that weren't even out yet. So, and a link to the SBA application, probably not, because the PPP application has to go through a bank. It's not SBA Direct. The question was, do we have the copy of the application? The other one, the $10,000 grant one, I think is direct. You just go on the SBA site and apply for it. But the PPP loan, you have to actually go through your bank. So I would get an email out or a phone call to your banker as soon as possible, or let Chris know you want to get on his list. And I don't know how many clients he's got to get through before you get to the top of the list. Money could be gone by then, but hopefully you've got a relationship with a banker, or if not, let's get in touch and find out who we can help you handle that. Any other questions or any other comments, Brandon or Chris, anything you think we should cover? Other than that, there's probably more to come, and look for more in emails when we know better or changes to what we've already said.
Did you mention that that on forgiveness, it's not taxable income?
Say that again? No, go right ahead.
Yeah. So the PPP loan, right? It can be forgiven if it's used for the correct cost. It's also not going to be considered taxable income.
Oh yeah. So the government's not just giving you money. They're giving you money, and they're not taxing it.
They're literally, just giving you like we've been talking about it internally as what does that journal entry look like?
Yeah.
Because it's not taxable income. You still get to take all the expenses. It's literally just like it turns into pretty much a capital contribution from yourself. Dollar for dollar. It's honestly, like, I think that's one of the, if not the biggest part for small businesses, the biggest part of the entire package is that.
Yeah.
So jump on it.
I hadn't thought about that, how it shows up in the company's books. That's tremendous.
Yeah.
A $0 capital contribution of 2.5 months worth of payroll and expenses.
Yep.
That's pretty powerful. Okay. Thank you, gentlemen, both for being on board. And if we have any other questions, I will make sure that we get to you and an email so you can communicate and answer those. Hopefully everybody got some good information out of what we talked about. This presentation has been recorded and will be posted, so you'll have the opportunity to hear it again if you didn't quite get it. I will tell you, I've found lots of good resources. Both these gentlemen have been sending me stuff for the last few days, weeks, saying, here's the latest, here's the next, here's the next, here's the next. And between that and going to the SBA site and going to the Treasury site and just hunting down information, we're hoping to give you enough information to make some great choices and good decisions to keep your employees employed. Until future and until we have a chance to chat again, wash your hands, don't touch your face, keep up the good work of keeping America great, and know that these markets will recover. And if you have investment questions, insurance questions, any other, these or otherwise, let us know. For those of you that are clients of Raskin Global, know that we have started our call list. We spent all of last week and have started straight through that list this week. We are calling people age, as I said on the last call we did, oldest to youngest. And the reason for that is all these required minimum distribution and IRA movement rules and things that we felt needed to be communicated. So we've started with the oldest. We're working down to the youngest. And so if you haven't been called yet, it's just because you're younger than, I guess, our average, because we're not quite to the middle yet. And if you haven't been called yet and you want to be called sooner, just zip us an email. Tell us you want to get on the calendar, and you will have an appointment scheduled. And you don't have to wait for your name to fall in the list of age. So we will get you either by age or by email. If you want to get in sooner, just send an email to me and we will follow up with you and get you on the calendar sooner. So with that having been said, we're going to wrap up for the day. Thanks for being here and for asking your questions. If you have anything else, you know where to find us. Again, I want to say thank you to Chris Marasco, Revere Bank. Thank you to Brandon Hall, Hall CPA, and Tom with Hall CPA for putting up the post for their printout. I will make sure if you didn't get the link for that, that everybody gets a copy of that link so that you can take a look at the information that they've put together in that report. Have a great night, everybody. Stay well.
Thanks, Leonard. You also.
Pleasure.